To calculate interest, you need to know three things. The first is principal. This is the amount of the note receivable. A note receivable represents that someone owes you money and has signed a note saying that they promise to pay you X amount with interest in so many days. The second thing is the time period. The time period is the amount of time that the note must be paid in. If it is 1 year, then it is a 1. If it is 2 months, though, then it is 2/12. And the third thing is the interest rate. Interest is always stated at an annual rate. Often students get confused here. It's best explained by showing an example. The interest formula is interest equals principal times time times rate. The interest calculation on a 1 year, 12-month, $100,000 note receivable at 6% would be $100,000 times 1 times 6% equals $6,000. The interest calculation on a 1 month, now that's 1/12 of a year, $100,000 note receivable at 6% would be $100,000 times 1/12 times 6% equals $500. The interest calculation on a 2-month, now that's 2/12 of a year, $100,000 note receivable at 6% would be $100,000 times 2/12 times 6% equals $1,000. The interest rate is always given based on a 1-year rate. Here is an example showing the recording of a note receivable with interest. On June 1st, you made the sale for $100,000. The buyer signs a note promising to pay the $100,000 in 2 months with 6% interest. You record the note receivable as a debit to the asset account note receivable and a credit to the sales revenue account. The journal entries are posted to the ledger accounts. On June 30, you record the earning of 1 month interest. You won't be paid until July 31st, but you have earned 1 month's interest after 30 days. The interest calculation for 1 month, 1/12 of a year, for the $100,000 note receivable at 6% would be $100,000 times 1/12 times 6% equals $500. This amount has been earned by you and is now owed to you. Therefore, you need to record an entry showing the interest receivable and the interest income. The journal entry would be a debit to the asset interest receivable and a credit to the revenue account interest income. The journal entries are posted to the ledger accounts. On July 31st, you are paid. The total amount of the payment consists of the principal and all the interest owed. We were owed interest for 2 months, so the total interest earned is $500 times 2 equals $1,000. However, you already recorded 1 month's interest, so now you only have to record the 2nd month's interest of $500. The note receivable is paid off, therefore it must be credited for $100,000. The interest receivable is also paid off. That must be credited for $500. you earned an additional month's interest of $500. This is credited to the interest income account. The total cash you are paid is $101,000. This is the $100,000 for the principal and $1,000 for the interest. The amount is debited to cash. The journal entry is then posted to the ledger. Note that the note receivable and interest receivable accounts are now zero. The interest income account now totals $1,000 as you earned $500 in June and $500 in July.